All right, we're live, aren't we, Austin?
We are live. Yep. Thanks everyone who's joining in
Great.
for us live. And hello to everyone who's also watching our recording here. We'll go ahead and get started here in just a bit with our July market.
Yeah, so it sounded like you cut out there for a second. So just wanted to welcome everyone in. My name is Neil Kane. I'm a certified financial planner, um, and I'm accompanied by my great colleague here, Austin Costello, also a certified financial planner. Wanted to do some housekeeping items for you guys and just kind of talk about how to communicate, how you guys can communicate with us on this. Since this is a live session, we have a chat that is available now. In order to access that, you have to be a YouTube account user. So if you aren't and you have some questions, you can always um, uh, wait to the end. We have a QR code. You can either sign up for a meeting. You can additionally email us. Any other things you wanted to add to that, Austin?
No, just if you guys have just come on for these commentaries that we've been doing monthly, just an invitation to also check out all of our other recorded items on YouTube. We've been putting more effort into building out the page here for you guys. So yeah, don't be afraid to check that out.
Which actually brings up to mind here that I am just about to finish up the recording that I'm going to do on Medicare Part B. Lots of questions about Medicare Part B as a federal retiree, how that blends in with your FEHB and whether you need FEHB or not. So I've got a good recording that will be posted within the next couple days or week to our YouTube channel. And I think that's going to solve a lot of questions, hopefully, solve a lot of questions. It might create some more questions, but it will hopefully give you guys some added material on that decision process around adding Medicare Part B in retirement.
Great. Well, we'll go ahead and get started then. So this before I even start there, I'll just start with an explanation of what we're going to be covering today. If you sat in on these market commentaries, you know what we like to do is explore what's going on in the market right now. The good, the bad, the ugly. Kind of look at it from different angles and fill you in on what's informing us as investment managers and financial planners, and also hopefully help you guys have a greater understanding of what's going on as well. So, if you've been paying attention at all to the markets this year, man, things just keep going up. We've hit record high after record high, and this is coming just after a time that seems like everybody was concerned about a recession, concerned about the economy, and still to this day, if you've been sitting on these commentaries, you've heard us express concerns about the economy and a potential future recession and things like that. And so, again, on this call, we wanted to go through what's contributing to this massive growth that we've seen this year, but then also cover the other side of that on maybe reasons that we still have to be cautious going forward. So when you look at this year 2024 in terms of a historical market year, and we can even look at this in terms of non-presidential election years here in the light blue, and presidential election years in the dark blue, and you can see that honestly, whether it's a presidential election year or not, things usually tend to go about the same. We've had a lot of questions on that, but this year we have dramatically outperformed the average year. So what is going into that? Why is this happening? Why are we seeing this dramatic outperformance, especially in the first half of the year? Well, the answer really boils down to the technology sector has taken off like a rocket this year and has, regardless of what the rest of the market has been doing, the technology sector has kind of grabbed the market by its scruff and just lifted it up, right? And so you see here the technology sector has had extreme growth, but when you look at the rest of the market, really everything else except for communication services here, we've had kind of a flat to negative year, all except for technology. And the big, the impetus behind this growth in technology has been all the conversation around artificial intelligence, AI, right? Artificial intelligence, the narrative behind that is it's going to add efficiency to all of these companies, especially the big tech companies, which is going to drive earnings, it's going to cut costs. And there's a lot of optimism around what the future of artificial intelligence, or what artificial intelligence means for the future of the market, technology, for profits, things like that. And one interesting thing to look at here, you can get a really good gauge on what's important to these large companies by listening to their earnings calls and seeing what's mentioned, right? And
nobody wants to talk about recessions anymore, apparently.
And nobody wants to talk about recessions anymore. So what's happening is when you listen to these earnings calls, CEOs, at the beginning of last year, or 2022, even into last year, everybody was talking about recessions, right? And every earnings call, at least once per call, they were mentioning recessions. Nobody is talking about recessions anymore. Everyone's talking about artificial intelligence. Almost 2 times per earnings call, artificial intelligence, or AI, is getting brought up. And so you can really see where the focus is right now. Like I said before, this is just another way to kind of visualize what's contributing to these returns in the market, these massive returns that we've been seeing. Well, at the end of last year, we were starting to see that the broader market was really picking up. Okay, we started to talk about this. This is when some of the recession fears started to ease. Okay, but as we've seen, at the beginning of this year, we've started to see the broader market really kind of feel the pain from some of the inflation, from consumers, struggling a little bit more, and the broader market is starting to now, as far as second quarter of 2024, actually detract from the overall earnings. But artificial intelligence here in green has just kept this steady growth that's just pulling everything along. So we've really seen AI take over, and even if without that, it's very possible that we could be in a recession. But with AI, has kept things along. So, Neil, what does that look like in terms of the broader perspective, or the historical perspective, with AI?
Yeah. So 2 takeaways. One, if we kind of go back to the last slide, Austin, if you will,
Yep.
Right? It's looking like for Q2, essentially only a handful of stocks are positive. Everything else is negative, right? So if you're not in just those, call it 6 to 10 stocks, you're not feeling from your stock portfolio much of an increase at all. Now, keep in mind, these indexes like the S&P 500 and the NASDAQ are heavily weighted in just those groups of names. But this is one of those scenarios where, everything else, the 490 companies in the S&P 500 are negative. So that's really interesting to see just on this chart level. The other thing I'd like you to take us back to, Austin, if you don't mind, I think is slide 6. Just pump me back to slides 5. Okay. So we're seeing this atypical, let's call it green shoot in the market, right? And we now know, right, where that is coming from. That big push forward is really coming from those 10. We're approaching areas, right, of how much more gain can this S&P 500 have from here, right? If you look at the quintessential return on a non-presidential election year or a presidential election year, we're pretty much at that top range. I was listening to the mid-year outlook call with LPL yesterday, actually. And what they're calling for, their analysts are calling for really little to no more gain from the S&P 500 this year, unless the group of 5 to 10 surprise more to the upside. But as far as everything else goes, they're really not calling for much. And they're really calling for bonds to produce most of any sort of gains from here on out. I saw them produce a chart yesterday, essentially with bonds being a lot more attractively valued than the P ratios of stocks. We don't have that to share with you today, but I thought it was interesting. It really tied in their explanation of that with where we are on the S&P 500 this year compared to most years, and really tied into the reasoning of why they just didn't expect much more out of that market for this year. And this is a good slide to kind of show that as well. So advance me up to my slide 9, Austin, if you don't mind. So record highs for market concentration. So this again feeds into the theme of why we are cautious, right? The reason for being cautious right now is, again, that low breadth of the market's participation of the rest of the 490, let's call it, of the S&P 500. We have really record low levels over the last decade. Measuring over the last decade, you have really low levels here. Only 17% of stocks or of companies are actually outperforming the index. Usually that's about a 50-50, right? You got half outperforming the index and half not. So therefore you got that average. Right now we have only 17%. You got to go back, way back, more than what this chart is showing, of that record low level. So if you just aren't in those companies, or you're taking more of a diversified approach, right, you're not going to be experiencing the same gain, let's say, that the S&P 500 is. But that is a reason for concern right now, is this record high concentration. If there's any disappointment amongst those leadership, you really are have kind of what we call a soft index in terms of that. Anything to add there, Austin?
No, I mean, I think that's a great point. It's just the number of companies that are, I mean, when you just think of that, right? You got 100, or, we'll just make it 100 companies, right? You've got 100 companies and only 17 of them are performing better than the average, right? But when you think about how strong the growth has been, think about how much better those 17% are doing than everyone else.
Yeah.
It's pretty extreme to think about. And honestly, this chart that I was about to go to, that Neil's about to talk through, shows really even how more concentrated it is than that.
Right. We had a question from Mike. Mike, hello. Welcome. Thanks for joining the call. Mike's question is, what percentage of companies have reported Q2 earnings, given that today is July 12th, or is Q2 not April from June? From my understanding, the majority have reported, which is why you've seen a big green shoot in the market already. You've got the tech companies that have reported. I don't know the exact percentage. Do you, Austin?
I don't know the exact. We're just kind of starting the earnings season right now, since we ended in June. But yeah, I don't have the exact percentage.
Yeah, Mike, to answer your question, the majority have. You had a lot of those calls coming in there in June, end of June, and I think that's why you're seeing kind of the spike in the market. We could get that exact percentage for you, though, if you need it. Now, going further into the theme of what we're discussing, right? Who's been the workhorse of the S&P 500? It's no other than NVIDIA. NVIDIA blows away really any other company when it comes to year-to-date gains for the S&P 500, also known as your C fund for federal for us, the federal folks joining in. 30% of the market's gains are coming from one company. Okay, now it's not 30% gain of the market, obviously, but 30% of that market's gains, 1/3 of the gains of the market is from one company. That's insane. So that just goes to show you really how weak the market's performance is this year. I mean, it's a great performance from the market, but how much does it have to stand on, right? If any of these chips fall, you're kind of peeling back that market's return fairly quickly when you're talking about 1 out of 500 companies is contributing to 1/3 of the market's gains. So the close kind of second and thirds behind that are going to be your Amazon, right? Your Microsoft and some of the other kind of companies in there. But it has been really a NVIDIA show here for the market. Anything else to comment there on, Austin?
No, no, I really don't. I mean, I think it just to to relate it back to these conversations that Neil and I have all the time with you guys, our clients, is we'll have people ask why why is the S&P 500 doing so well this year and my portfolio isn't, and the real answer is like we don't feel comfortable having 30% of your portfolio in this small group of companies, and I think the more we go through these commentaries and the more you learn, hopefully you feel the same way and kind of understand that. Yeah, we'd love to have the growth that we're seeing in the market this year, but when you look at the small group of companies that it's coming from, how sustainable is that? And this next chart here, I think Neil shows a similar story.
Right. Just looking today, NVIDIA is at 80 times earnings, 80 ADP ratio. That's fairly extreme. We saw Tesla hit that and then bounce off of 80 actually a few months ago and fell, call it 20%. So yeah, it would be great to chase the returns of NVIDIA, but at what point is it just too expensive, right? So going back into the theme of market cap. So market cap, I don't know if we've explained this in previous presentations before, but for folks that are not privy with a market cap weighting versus equal weighting, essentially means that the market cap S&P 500 is weighted by the size of a company's valuation versus an equal weight S&P 500 sets all the weightings of the 500 companies equally. So what I thought was interesting here is if you look at January 2023 to January 2024, the equal weight index did not move much, right? And I don't think anyone came into last year thinking the market was going to move this extreme amount. And I don't even think that folks came into this year thinking the market was going to move this extreme amount. And if you look at the equal weight index, when you set all of these 500 companies to an equal setting, and you don't have that strong concentration in the S&P 500, what do you have? About 7.5% rate of return over the last, call it year and a half ish, something in that neighborhood. Not a lot. And if we were to put in a 2-year period and go back to July 2022, it wouldn't even be that, because July 22 was pretty, markets were pretty bad by that time. So when we look at the whole market and we take out that concentration, we have, call it, below average returns, right? And one thing that I think isn't reflected here that I think would be nice to see, and I'm not going to just throw this in here, is looking at the equal weight S&P 500 versus the market weight for the last 20 years. For the last 20 years, the equal weight index generally sat above the market cap index almost every year for the last 20 years, slightly above. And in fact, if you roll the equal weight and the market cap for the last 20-year period, they're about equal right now. They're about equal. So what's interesting to see is this huge separation from the normal equal weight index, let's call it, versus this market cap, which has 35% in this just these 10 tech companies. It's getting larger and wider and wider. And here, the lesson here is if you kind of look over history, you look at 20 years of this data, they eventually revert back to the mean. And the question really at this point is when? When does that happen? We don't know that. But what we do know is this big separation and this huge surge that we see to the market cap is not something at this point that we feel comfortable chasing, right? And we know that the market cap has extreme kind of valuation towards that, where the equal weight is a lot more reasonably valued. So if we were to show a graph going back 20 years, and maybe we do that at some point, Austin, is these have generally kind of kept pace with each other. And yes, some of the times, right, the market cap can kind of come out of whack, but generally that reverts back to the mean. Any other things to share on this slide, Austin?
No, I think it's just worth a reminder that when we say market cap weighted, we're talking about the S&P 500 index. The normal S&P 500 index is market cap weighted. So that's
Right.
what we're looking. It's weighted by the size of the company. Same with the C fund in your TSP. It is that follows the S&P 500. It is market cap weighted. And when we showed a chart on the last commentary, maybe the one before that, where when we look at the market cap weighted, or we look at the C fund, we look at the S&P 500, over a third of that fund right now is in 10 companies. And so that's what can happen when you're market cap weighted, right? There's these companies now are giant. $3 trillion for Apple, for Nvidia, right? And so when those massive companies are doing well, they can really move a 500 company index. A third of that index is in 10 companies. Do you call that good diversification? So I just think it's worth noting that when we say market cap weighted, that is the normal S&P 500. This RSP, or the equal weighted, is in my opinion more indicative of an actual diversified portfolio. So anyway,
And I would add in there too, like for the person that really doesn't understand these things, right? Let's say the S&P 500 market cap, the C fund, were to go into a correction mode by 25% and just come back to the equal weight. I think someone in the industry like ourselves would be like, well, yeah. But for someone that didn't understand really what was going on there, they'd be like, holy cow, 25% correction? How can that possibly drop 25% when maybe the economy is not completely in a bad state? It's just a reversion back to the mean. So it's something for you guys to educate yourselves on. Sure, use your market cap index, but just understand use your C fund, let's say, but just understand the dangers there. And if you start to get a reversion back to the mean, it may not be something to just necessarily panic on. It's just a reversion back to the mean. So giving you all that education is about understanding your funds a little bit more. I know some folks are sitting in, they're retired, maybe they don't have as much in their C fund and they've rolled that money out. But folks that are tuning in that do have substantial amount of money in their C fund, which has been the lion's share of where all the gains have been in the TSP, need to understand that concept of what's going on. And it's not necessarily something that is a panic situation. It would just be a reversion back, in my opinion.
Yeah, and that's a great point, Neil. Like we're not saying here the C fund is bad, the S&P 500 is bad. Like please don't hear that. I think what we're trying to say here is for the person, like I met with a couple people recently, because this is all over the news, right? Oh, the market's having a great year. We're hitting new highs every day. And we have clients coming to us saying, I should probably put more in the C fund now, right? Like everything's going really well. I should probably shouldn't I be putting more in the market like when this is going well? And we're just cautious about that. Okay, that we're going to say, okay, hey, how close are you to retirement? When are you going to need this money? If you're going to need this money in the next 3 years, 5 years, depending on the situation, I might not be adding to the C fund, even though it's doing well, because we think it might be a little overvalued. Now, if you've got a long time, or if you've got 10, 15, 20 years ahead of you, don't listen to what we're saying right now and hear I shouldn't be in the C fund. Okay. We still see positive movement for this over time. It's just that we're, over this next short-ish time period, we're a little cautious. So I always like to clarify that and make sure you don't hear that S&P 500 is a bad place to be. Now, moving on to kind of the other side of this, right? We're looking on one hand at the market being really strong, right? We've seen the market be really strong. And when we talk about that there could still be weakness in the economy, sometimes people are like, really? Like, everything looks like it's coming out. We've got inflation coming down. Like, what are we really looking at here? And so what's interesting is analysts actually kind of share that opinion. Analysts have been saying the recession fears, or the consensus of analysts saying that there's going to be a recession within a year, has gone from about 60% of analysts in 2023, and that steadily dropped throughout this year down to about 30% now. Less and less analysts are saying that they anticipate a recession coming. And companies, analysts are also looking at the companies in the S&P 500, and they're looking out over this next year, and they're saying, well, I think their earnings are going to be increasing, right? I think we're going to see, high single-digit earnings growth over this next year. We might see double-digit earnings growth in Q4. It's looking like things are moving in the right direction for companies if what they're anticipating to be true becomes true. They're also looking at interest rates. Now, there's a lot going on in this chart here, but what this really shows is when the Federal Reserve Board, when the group that sets interest rates for the U.S., when they get together, they take a poll, and they poll themselves on where they think interest rates will be at various points in time. And so what this shows is there's a downward trend, right? The majority of members of the Federal Reserve Board actually think there will be an interest rate cut by the end of 2024. And by the end of 2025, that we should be a full percent lower than we are now. So that's reason to be hopeful, right? We've got inflation coming down. We've got interest rates potentially coming down. But here's a historical perspective on all that. Okay. Consumers, everyday people, tend to be a very poor judge of what's about to happen in the economy. Okay. As a matter of fact, if you did exactly the opposite of what consumer expectations said, historically, you would be a pretty good investor. Okay. And here's an example of that. Okay. When you look at the Conference Board consumer expectations, okay, what are consumers thinking about business conditions right now? Okay. Do you think business conditions are getting better or worse? Okay. If you look at what's happening right now, consumers are thinking that business conditions are getting worse. Okay. They're seeing what's happening. They're saying, I think business conditions are getting worse. But they think when you ask the consumer, what do you think stock prices are going to do? Are they going to increase or decrease? Even though they just said, hey, I think business conditions are getting worse, they say, well, I'm feeling very confident right now that stock prices are going to go up in the next year. Okay. So consumers are becoming, they're getting confident the stock prices are going up, but they feel like business conditions are getting worse. There's a disconnection there. Okay.
It,
So,
and,
Neil, yeah.
and that isn't that reminiscent to '08 a little bit? Like look at like from '05 to 2008,
Mm-hmm.
expectations for businesses are sliding there, right? They're sliding down. But their expectations of stock prices are moving higher.
Yep.
So what that tells me, right, is high expectations, high expectations lead to disappointment, right? And that's what we're kind of seeing here is this exuberant expectation that the market will continue to increase and that just a couple of charts ago, Austin, if you go back to the earnings expectations, like look at that, what their analysts are expecting in Q4, 17.4% share growth and expectations on earnings. That's super high. I mean, that's double anything we've seen over there on basically a couple years. So the way that we kind of see things is what could lead to a bust is, in my opinion, not even a, a deep or difficult recession. It's just a garden style recession at this point because things are running so hot on the market cap separating so much from just the normal, equal weight. You've got these exuberant expectations on earnings. You've got expectations go forward one more slide for me. These expectations that the Fed's going to cut, right, and is going to stimulate this market even further. And what happens if that all doesn't happen in that perfect way, right?
Yeah. And one more thing on that is, we can remove the recession word from that entirely. Like if there wasn't a recession at all, and just instead of 8% and 17% earnings growth, we saw 4% and 6%.
Yeah.
That would significantly impact. Like right now,
Tough market.
the market is acting like it's basing its current returns off of what these analysts are projecting for the next few quarters. Right? It's looking forward. It's asking what the market is projecting, and it's basing its current value off that projected off the projected earnings. So even if we didn't see negative numbers, like it wouldn't take negative numbers. All we would need to see is these
Lower numbers.
expectations not be met, right?
Yep. Great point.
That's what that's why we're looking at this and just saying, okay, how much of this, even if it is realistic, are we pricing in the very best case scenario right now?
Yep. Yep.
Yeah. Here you go, Neil. We'll keep going from here.
Oh, okay. So, I mean, that kind of goes into the psychology, right, of how markets operate and the confidence that ends up leading to, again, disappointment. So if we take that theme and we look and we go back all the way to '08 and we look at consumer confidence when it peaked, that was typically the top of the market, right? So we go back to '08, consumer confidence peaked, call it, late '07. From there, that's essentially the peak in the market. The market's sliding as consumer confidence is sliding down lower, right? Then you have 2011. That's really not a great read there But the market basically went sideways for years after that, after consumer confidence peaked there in 11. You got 2021, a peak in confidence there, market slides. We're approaching that peak in confidence again. So if you look at investing more so in a contrarian way, do you want to be all in? Do you want to be all in on the AI trade, really overweight your PE ratios when everybody is exuberant about the market and confidence is at all-time highs, right? Or do you want to essentially take a contrarian bet that the latter may be more so our future reality here? So take that to the opposite side of this. When consumer confidence was at all-time lows, that generally gave us the bottom of markets, right? So if we have rewind the tape to 2009 there, right? And you just circled that with the green mark there. That was the bottom of the slide that we had in 2008. Okay, we had a false read, let's say a false bottom of consumer confidence there in 2016, right? That wasn't a bottom of the market. The market just kept trending forward there. But if you take 2022, that's a bottom in consumer confidence. That's the bottom of the market there, the bottom of that bear market that we had in 2022. So again, we're just back to exuberant levels in consumer confidence, which would tell us that adding on risk here or being full blown our risk in terms of risk appetite is probably not the best bet for the short term period of, let's call it 6 to 12 months, which is why we are taking throughout this summer months just a more hedged approach, more equal weight approach, and a more hedged approach to our market weightings here. Okay. Last slide of the day. Probability of recession drops before recession hits. And I think this kind of goes into some of the things you were talking about, Austin, which is the calls for a recession for analysts have started to actually go the opposite way here. In fact, hardly anyone's talking about it anymore. They're talking about the AI trade. But if you rewind the tape, you go back to 1980, it's very interesting to see that the calls for recession actually drop as the recession grows nearer. So if we look back at the 1980 period, it's kind of hard to see there. Those that line's kind of fudge. But if we look back, right, and we look back into, call it 1989, recession calls started dropping. Okay. We eventually did have that recession. It wasn't too near after those recession calls started dropping. 1999, same thing. Lots of exuberance in that period with tech and the trades that were going, the tech trade that was going on there. We eventually did have that recession. 2008, right? Recession calls start dropping. The probability of recession for next year starts to drop, and boom, all of a sudden it takes you by surprise. And I think that's kind of the caution that we are giving to our clients is, even though the coast looks clear, even though there are people out there that are essentially getting rid of the recession talk, we think that's a little early, right? Right now, we are still in a inverted yield curve. That would suggest that marker of a recession has been highly accurate. It just doesn't really give us perfect timing. So we're still in the camp that you still need to be cautious on your investments. Just because everybody else is calling for potentially that we're out of the woods, we don't think we are yet. So, do you got anything to add on this slide, Austin, to that? Any other things to mention?
No. I mean, I just think it's uncanny almost how similar each one of these cases are. And keep in mind here, there are times like, in the late 90s where the recession fears peaked and then dropped, and they were not followed by a recession. Okay. So it's not saying that this has to happen every time, but what we can say is a recession has never happened at the peak of recession fear. When everybody is scared about it is usually not when it happens. It's not till we think we're out of the woods. So, just like Neil said, a reminder to stay balanced, which is why the last 6 of these or so we've been wrapping up with this slide, and I just keep including it because I think it's so it still rings true. And the real consensus of what we have here is just now more than ever, even when it looks like a good idea, don't put all your eggs in one basket, right? Maintain a balance between growth and value. Be mindful of concentration risk. Be mindful of, if you're using a market cap weighted index, be mindful of how much of your money is in this small number of stocks. Use some other types of investments. Use small cap, use mid cap, use, especially international, like if you have access to an actively managed international fund. These can be really good ways to diversify. We didn't talk about bonds much today. We might focus on that a little more on the next call. But especially if interest rates start coming down, bond investments are going to be really, they're going to look really good compared to how they have, especially over the last couple of years. So this is just a reminder to be diversified. Don't put all your eggs in one basket. To go along with that, right? We always think about not letting our emotions drive our decisions when the market's coming down. That's when it's always focused upon, right? Don't sell. Don't let your emotions drive your decisions. Stay invested when the market's going down. The same thing can be applied to when the market's going up. When the market's going up, everybody feels like the smartest person in the room, right? Everybody feels like they're making the right decisions. Everything's going up. And honestly, if you're doing what everybody's talking about, you're making money, right? But the other foot typically drops eventually. And so not letting our emotion drive our decisions in this case means staying diversified even when a small concentration of stocks are the ones growing. Okay. Also understanding your risk tolerance. When the market's rising, it's really easy to think that you have a higher risk tolerance than you do. If your account right now lost 20%, 30% of its value, would you be able to sleep at night? That's the question to ask yourself. It can feel like everything's going up forever. History would tell us that's not the case. I'm not here to say when that's going to happen, but ask yourself the question and invest accordingly. Okay, be diversified, stay invested, always ring true. So we'll wrap up here. Neil mentioned at the beginning of the call, if you have questions that you have specifically for us, we'll try to answer some of those today. But really, the best way to get your questions answered is through one of these financial checkups. We offer these for free for anyone who comes to one of these webinars, has interacted with us in the past. This is an hour-long call with me, with Neil, with one of our other financial advisors, one of our other coaches, and we'll take the time and answer any of these questions that you have. What should you be doing in your TSP? Roth, should be using Roth. Should you be doing traditional? Is there anything else to save money on taxes? Neil was talking earlier about Social Security and Medicare and FEHB and how do all of those things, complement each other. We can give you advice on those types of things as well. So if you're interested in one of these financial checkups, interested in a one-on-one call with us, you can hit the QR code here or go to retfed.com/register and sign up for one of those today. So we'll keep doing these market commentaries on the YouTube channel. Make sure you're subscribed here for that. And Neil, if you don't have anything to add, I see another question in here, so we can move on to answering questions.
No, I think that fairly well covers it. I could take the question for Janet. Janet, great question. She asked, should we still have more in bonds than G fund? So when we're talking about the TSP, we're talking about the F fund being bonds and the G fund really being more like a cash proxy or like a money market. So the G fund's very susceptible to interest rate movements. Any adjustment upward, any adjustment downward, you'll have an immediate decrease of your interest rate. Whereas the F fund is interest rate sensitive, but essentially what happens is when the Federal Reserve is raising interest rates, that negatively impacts your investment in the F fund. But once the F fund, the Federal Reserve has set their interest rate, it is essentially telling you that's probably as high as we're going to go. And in fact, we're thinking about cutting. And then simultaneously, inflation's starting to actually come back in. In fact, yesterday's report on inflation was really good. We're now at 3% year over year inflation. That's not back to the target of what the Fed wants in the twos. But let's be honest, if we look at inflation over the course of like 100 years, it's been around 3 point something, right? So I don't think the Fed is going to raise interest rates into this. So you got good interest rates on bonds, plus the ability that the or plus the probability that the Federal Reserve will cut, whether that's just them cutting because they can, inflation's coming down, or the economy softens. I like the F fund over the G fund. Now, it doesn't mean you got to go all in on the F if you're using that as your bond proportion, but I like the F fund's probability to make more money over the course of the next 3 years than the G fund. I think that's a safer bet to have right now than really at any point in time since we've talked to you about this concept for the last 12 months. I think we're now approaching a pretty safe read that inflation shouldn't have a nasty resurgence. Now, that's unless if the Fed makes a mistake and substantially cuts rate here too early, that could lead for a second advancement in inflation, which is why you don't want to all eggs on your one basket on that F fund either, right? You want to leave a little bit in that G fund just in case they do, and then you could pop more into your F at even higher interest rates if the Fed goes up from here. But the probability of that happening is probably pretty low.
Yeah. Yeah. Thanks, Neil. And that's the last question that I see on here right now. You know, we can hang out for another couple seconds here, see if anybody else wants to put one in. But yeah, if not, thank you everyone for attending. Again, keep your eye out for that new video that Neil will be posting here in the next week or so, and subscribe to the page so you get these things as we list them, and sign up for a financial checkup if you haven't done that yet. We'd love to meet you. If you've been sitting on these webinars for a while and you haven't actually talked to us, we'd love to meet you and talk to you and see if we can help. So, Neil, do you have anything to add before we wrap it up?
No, stay cool out there. I heard we're having a record hot summer.
Just like the last 3 or 4, right?
That was just on the news yesterday about 1 degree higher than historical, at least in this area. So stay cool. Hope your ACs are tuned. Get your coolant so that you don't run out. Don't want to do that this summer, but that's not financial advice. So we'll save that for another session.
That's for our HVAC presentation coming up next month.
That's right.